Hi, everyone. Thank you for joining us today. Most of you likely already know me, but for those of you who don't know me, my name is Malika Dvovska, and I'm the Vice President of Corporate Development and Investor Relations for Newcore Gold. I'm joined today by Newcore Gold's President and CEO, Luke Alexander, as well as Newcore Gold's Vice President of Exploration, Greg Smith. Before we get started, I do want to highlight that we will be making forward-looking statements today. I encourage you all to visit our website where you can find the full cautionary language as well as a copy of this presentation. We are recording this webinar and it will be available for replay. We look forward to taking this opportunity today to provide you with a detailed overview of the results of the pre-feasibility study for our Enchi Gold project that we announced yesterday. This study is a culmination of 2 years of technical work and advancement on the project. It's an important milestone for the company as we continue to advance and de-risk the development of Enchi. As well, it's been a very busy first half of the year with an 80,000 meter drill program that is underway and that is delivering strong results. It highlights the higher grade and growth potential of the project. We're going to dive into some of those results, discuss what investors can expect for the remainder of this year, and then finish the webinar today by answering your questions. There is a chat function. Please use that to submit those questions, and we will address those at the end of the webinar post the presentation. So with that, I'm going to pass it over to Luke to dive right in. Thank you.
Yeah, thanks, Mal. First of all, I just want to address the sell-off that we've seen in our stock the last couple of days on the back of us publishing the PFS. Obviously, we've been in a very challenging gold market, and yesterday was another day where we saw a significant sell-off across the board. But ultimately, we underperformed the market significantly yesterday. Ultimately, management and board, we are aligned with shareholders. We own 12% of Newcore, so we do feel the pain and frustration alongside all of our investors. Today, I would say we are oversold. You were trading at a US $75 million valuation. That compares to an NPV that we outlined within this PFS of $500 million at a $3,800 gold price. And obviously, we've got a tremendous amount of exploration upside, which we'll get into in this presentation. So yes, the last couple of days have been very painful, but ultimately my personal view is we're completely oversold, and this PFS sets the foundation for us to create a lot of value from here. A huge amount of work has gone into this PFS over the last couple of years. We've worked with multiple consultants on putting this PFS together, Lycopodium, Fuse, SLR, DRA, Knight Piesel. That culminated in us deciding to go forward with a CIL project, which we announced early February. In hindsight, we should have done a better job of ultimately highlighting that the CIL project or a CIL project is more expensive from a CapEx perspective and from an operating perspective, and that it's not appropriate to ultimately compare it to a heap leach project. That's some of the feedback we've had over the last couple of days, and ultimately I take responsibility for not doing a better job of communicating the additional costs that come with a CIL project relative to a heap leach project. That being said, all of that technical work that we've done since the PEA in 2024 outlined that a CIL project is the best way forward. And over the last 24 hours, one of the things that has been very encouraging is we've had a tremendous amount of positive feedback from industry peers, as well as technically focused groups who've been very complimentary of the study that we've put forward. And we ultimately now see an opportunity to create a tremendous amount of value from here. We've got 28,000 meters of infill drilling that went into this PFS, which leaves us with an additional 52,000 meters of drilling that will ultimately go into additional studies. Greg will get into it, but all of the drilling that we've done so far this year is not included in this study. And we'll see the production profile in the early years And as we find additional higher grade material and feed that into future studies, we see a real opportunity to create value from here. So I see this as a tremendous buying opportunity, but ultimately, the pain is being felt by us and the rest of the board with the sell-off that we've seen over the last couple of days. Getting into the presentation, again, as I highlighted, management and board, we own 12% of Newcore, so we are truly aligned with shareholders from that perspective. We've outlined a PFS, which we're going to get into detail, which does outline very robust economics. And as we walk through this, remember, today we're trading at roughly a $75 million valuation US. We've got an 80,000 meter drill program, which we're going to get into, but obviously we've seen a lot of very positive results in 2026, and we're excited to incorporate that into future studies, as well as continue to get lots of drill results out to the market. Getting into the PFS itself, at a $3,800 gold price, which is what we used for our base case. If we look at the average gold price for 2026, we're looking at $4,800. Obviously, the market has seen a significant sell-off from a gold price perspective, but our view is 3,800's a appropriate price to use, and we see a tremendous amount of upside for the gold price from here. At 3,800, we outlined an after-tax NPV of just under 500 million, after-tax IRR of 37%, and a 1.6-year payback. We'll get into the all-in sustaining costs, but those are above $2,000. And part of the reason for that is the additional royalties that we're seeing in Ghana, as well as it being a lower grade project. But in those early years, as we find additional higher grade material, you'll see the positive impact that has from an AISC perspective. $351 million of upfront capital. When you look at these projects, 5-6 million ton per annum projects, we're looking at a 5.5 million ton per annum operation. This lines up very well with other studies that we've got out there. Just under 1 million ounces of recoverable gold and 104,000 ounces over the life of the mine. But importantly, we're seeing 130,000 ounces of average production in the first 3 years. And with all of the exploration work that we're doing now, we're looking to continue to add ounces after year 3, higher grade, that will ultimately bolster the production profile. And then again, as a reminder, we've got a very large land package, 248 square kilometers in size. We worked with Lycopodium as our lead consultant on this project. They've got a very good reputation in West Africa. They're arguably the gold standard in West Africa. You can see the other companies that they've worked with over the last number of years. In Ghana specifically, they've been working with Newmont on their Ahafo project, as well as their recent $1 billion expansion at Ahafo North. So again, all this points to the fact that the technical work that has gone into this study is very defendable and sets us up really well to grow from here. Supporting Lycopodium were Knight Piesel, Fuse, SLR, and DRA. Again, all very well recognized international groups. Looking at the project itself, 5.5 million tons per annum. We do assume contract mining throughout the project. That is the main way that mines operate in Ghana, is through contract mining. Strip ratio of 4.3 to 1. One of the things that helps from a capital perspective is we have minimal pre-stripping on the project, which is a real benefit. We did talk about the NPV of 496 million, 37% IRR, and a short payback period. We will talk in a little bit of detail, but ultimately, when you look at the first 3 years of our project, an average of 130,000 ounces of production. That's really driven by some of the higher grade material that we see in our early years. With the exploration that we're doing now, we're ultimately looking to add additional higher grade material in that 0.8 gram or higher range, which then obviously will contribute additional ounces in years 4 and beyond, which we see as a real opportunity to drive additional value. From a all-in sustaining cost perspective, starting with operating costs, we're looking at just under $1,700, cash costs of just over $2,100, and then all-in sustaining of just under $2,300. As I highlighted, when we then look at the first 3 years, which we're ultimately going to look to add to with this drilling, you can see the impact it has from a cost perspective. Our operating costs drop down to $1,400, cash costs down to $1,850, and our all-in sustaining just below $2,000. So this is one of the building blocks for us, is to continue to add this higher grade material, which will then ultimately really contribute to the NPV and IRR. With our covering analysts who put out notes yesterday, SCP, Haywood, and Canaccord, if you receive any of their research, I would encourage you to go look at that research. A number of them honed in on this opportunity from exploration perspective to ultimately add additional high grade and the impact that that will have from a NPV and return perspective. We are in the midst of a 80,000 meter drill program. None of the results that we've put out so far in 2026 are included in this PFS. Of the 80,000, only 28,000 meters have been included. And you can see here, a number of the higher grade results that we've had, which we're excited to include in future resource updates and studies. In terms of some of the drilling that we're doing at the moment, we've got 4 drill rigs turning, 3 diamond and 1 RC rig. That RC rig is focused on near surface targets that we've identified, stepping out along strike, also doing some additional infill drilling to look to convert some of our 600,000 ounces of inferred resource that we've identified that will add to future studies. But with the diamond rigs, what we're focusing on is some of the higher grade shoots that we've identified on our project. When we look at a long section of our Enchi project and we compare it to the Toronto mine, where you'll see a lot of these deposits really grow in size and an increase in grade, is as you start to identify these high grade feeder zones. With the drilling that we've released so far in 2026, you can see where we've honed in on some of these higher grade feeder zones. Looking here at our Boeing deposit, you can start to see where these structures ultimately sit. And when you look at the results that we've been getting, they're very encouraging in terms of being able to add ounces. 147 grams over a meter, 173 grams over a meter. Sitting here, we've got 2 grams over 16 and a half meters. All of this is sitting immediately below our resource pits. To the north of that, 1.2 grams over 33 meters. An additional 1.7 grams over 22, 3.2 over 17. Again, all of this sitting immediately below the resource pits that we've got. As we can complete this additional 50,000 meters that's not included in our current MRE or PFS, we'll then ultimately look to incorporate that into our resource, look to add that higher grade material, which will then further support the economics in a full feasibility study. We are looking at a district scale project, 248 square kilometers in size. When we look at the PFS specifically, We've got Sium as our largest deposit, followed by Boyne. The infrastructure does sit immediately between the two deposits, and 82% of all the material does come from those two deposits. The additional material comes from our Nyam and Quachikroom deposits. Looking at the production profile, again, 104,000 ounces of production over the life of the mine. In those first 3 years, with that higher grade material that we're seeing, we average 130,000 ounces of production. With this additional exploration that we're doing and additional higher grade material that we bring in, what we're ultimately going to be looking to do is add additional higher grade into the mine plan, which then obviously should add to the overall NPV and return for the project. So we really see this PFS as a data point in time and ultimately an opportunity for us to create significant value from here through the drill bit and ultimately through additional optimization. From a payback perspective, again, using our base case of $3,800, we're looking at a 1.6 year payback. In year one, we have 230 million of after-tax cash flow. Year two, 190. Year three, 140 million. So it's a very low payback period. When we then increase that to what was spot when we were putting these numbers together at the beginning of the week of $4,200, we're looking at a 1.4 year payback. So very nice payback period. And then obviously lots of additional cash flow beyond that. From a sensitivity perspective, one of the things with a lower grade project, which is what we have, there is a tremendous amount of leverage to the gold price. We outlined the base case of $3,800, which produces an after-tax NPV of 496. But if we were to take the average for 2026, which is $4,700, $4,800, or if we use 45 in this case, you're looking at $775 million of after-tax NPV. That ultimately rises to 1.1 billion once you hit 5,500, which is where we peaked out in 2026. So that's the opportunity, is if you see gold going higher, then obviously our Enchi project does produce a tremendous amount of leverage. And it's important to reiterate that my view is we are completely oversold, sitting at a $75 million US valuation today relative to the base case that we outlined, let alone the upside cases if you feel gold is going higher. From a processing perspective, you can go onto our website. Our presentation is sitting there, and you can go through this flow sheet in detail if you like. But ultimately, it's a standard milling and CIL processing flow sheet. These have been built throughout West Africa. Again, this is the reason we're getting such positive feedback from our peers who are operating in West Africa, is there's a lot of familiarity with this type of a process, which was one of the main reasons we decided to go forward with the CIL in this PFS. From an infrastructure perspective, we've got good infrastructure. We've got a paved road that runs through the middle of our project to the town of Enchi. Enchi sits about 10 kilometers away as a crow flies, so we don't see any issues in terms of relocation with the main town. But ultimately, one of the real advantages is we can house all of our employees here in the town of Enchi, which creates a lot of benefits for the community there. Looking at the infrastructure and the site layout in a little bit more detail, and if we lay it over top of our 248 square kilometer land package, as I mentioned, Boyne and Sium are our two largest deposits. About 80 92% of the material comes from, or 80% comes from those two deposits. Truck it directly to a central processing facility. The tailings dams are valley dams that sit right next to that processing facility. So a nice compact footprint from a mining perspective. We've then got our Nyam deposit and Quachikroon deposit, which we then truck the material from those two deposits down to that central processing facility. So a nice kind of tight layout from a mining perspective that includes all of the infrastructure within a nice compact area. Again, you can go to our website and look at this mine plan in more detail. From a strip perspective, we're looking at 4.3 strip ratio across the project. One of the important things to continue to highlight is that when you look at the average pit depth, vertical depth for all the pits on our project, the average is roughly 85 meters. So all of those drill holes that Greg's going to get into a little bit of detail on, and the ones that I was just highlighting in that cross section, those are primarily sitting immediately below our existing pits. So my view is there will be an opportunity to pull those in to future pits, which obviously, again, will add to the overall production profile and returns for the project. From a depth perspective, they average between 60 and 220 meters across the project. From a capital perspective, I would encourage you to go and look at other projects in West Africa that have been recently built, and you'll see that this number is very defendable. $351 million capex. We do see some opportunities for optimization as well, which we will look at within our feasibility study. From a sustaining capital perspective, we're looking at 134. The bulk of that comes from the tailing dam expansion as we raise that tailing dam as we move through the life of mine. That's where the bulk of the capex comes from. And then from a contingency perspective, it's important to highlight that we're looking at about an 8% contingency for this project as well. So again, lots of additional fat built into this capex number. We're looking at a 24-month build. Our view is that we will be able to build it in a shorter timeline than that, which again creates an additional optimization opportunity for us in the future. Looking at it from a all-in sustaining cost perspective, we touched on this briefly, but we're looking at roughly $1,700 of operating costs. We then have roughly $460 of royalty costs. This does include the new royalty regime in Ghana. So it is a sliding scale royalty, which ranges between 5 and 12%. So using our base case of $3,800, this includes a 10% royalty to the government of Ghana, and then an additional 2% to Triple Flag. And then we've got our all-in sustaining cost of roughly $2,300. From a reserve perspective, we have just over 1 million ounces of reserves. This is the first reserves that we have declared on the project now that we are looking at a full PFS. Indicated ounces of 1.5, and then an additional inferred of roughly 600,000. One of the things we will look to do is continue to move those inferred ounces into the indicated category and then ultimately into reserves over time. So part of our drill program is focusing in on some of the higher grade inferred ounces that we've identified across the project and looking to start to convert those, which will then go into future mine plans. Important to reiterate that this PFS only includes 28,000 of our 80,000 meter drill program. So all of the drilling that we've done since October of 2025 is not included in this. And we see that as a real opportunity to add ounces and help, ultimately contribute to the NPV of this project over time. And then 85 meters average vertical depth, and really just that first 150 meters on our project is what has been tested, and we see tremendous opportunity to continue to add value through the drill bit and with this ongoing 80,000 meter drill program and the 4 drill rigs that are turning on site at the moment. With that, I'll turn it over to Greg, and he can get into the specifics of some of the exploration.
Thanks, Luke. So, as Luke mentioned, we've got 4 rigs going on the project now, and we have had for the last few months. We've made a number of news releases already this year, and certainly expect to continue to have a number of additional results coming out as they're available. So just really quickly, in terms of Ghana, again, it's a great jurisdiction. It's Africa's largest gold producer, number 6 in the world. Obviously, a number of large companies operating there. Lucas talked about Newmont and their investment that they're making to basically double their production in country as well. Again, 3 of the other top 10 gold mining companies globally operating there. A great place to significant M&A activity over the last number of years, and again, some very significant investments in additional projects. So, even though it's a long-lived area for gold mining, the Ashanti Belt in particular, and then we're located here on the newer, if you will, Sefwi Bibiani Belt with that a Ahafo mine. Thousands of years basically of gold production here, but you're still finding new deposits. You're still having companies make significant investments to expand their footprint and their production there. And again, a number of projects that even with their long lives have continued to find additional resources. So we're again located on this Bibiani shear zone. Most adjacent to us is the Toronto mine and then the Bibiani mine. They're located along this same large regional shear zone, and where the gold is actually all of the splays coming off of these shears. So very similar geological environment to a couple of areas here that are sort of +5, +6 million ounces. Obviously a lot longer life here. Toronto's been operating for a dozen years. And again, as Lucas said, this PFS is obviously the first time we've had a pre-feasibility study on the project, and is really a snapshot in time, and we believe something to build on. And how we're going to build on that is with this 80,000 meter program. Again, the first 28,000 meters was focused on near surface mineralization. The infill, we were very successful in converting inferred into the indicated category. Between the last 2 MREs, we went from 700,000 to the current over 1.5 million. We will continue in some areas where we've got some better grades to move additional inferred material into the indicated categories. And obviously, as we continue on with these into the feasibility study, that's what's available to you. You cannot include the inferred material in these economic studies. They provide an upside, but that's why we'll continue to look to do that where the average grades warrant. I've mentioned we've reported a number of news releases this year. Luke has highlighted some of these numbers. Again, some really good, a well above average grades over nice wide widths. This is probably one of the stars of the show here, where you've got 1.7 over 25 and an additional 3.22 over 17. And again, this is below the level of the current pit. So we're looking at extensions to mineralization here. We believe that this will allow us to both extend the pits into some of this material and then start to define underground material as we do some additional drilling around that area. We had exciting hole this year as well, and you've seen all of the drilling that's been done. This was actually the very first hole that encountered visible gold, and again we can see that it's below the level of the current pits, below all of the material that was included in the PFS. So great to see this. Certainly the geologists on site were excited, and we've actually now got some holes, additional holes planned in that area. So we'll just move now into the some of the 3D images. So you've seen this image here. Luke's highlighted the Sium deposit and the Boyne deposit. So again, between those over 80% of the ore that's in the pre-feasibility study is coming from those two adjacent deposits. The infrastructure is going between them. So again, that all works well from having a small footprint to the development, and then just a little bit of material coming from the satellite deposits at Nyam and Quachikrum. We'll look now at Boyne. We've talked a lot about Boyne, and that's because we've again been doing a lot of drilling there recently. Those were the resource blocks there. We're just focusing in here on the higher grade material. Again, we've seen some of these holes highlighted in the earlier slides. This is all of the drilling that we've done this year, and you can see it's all outside of the mineral resource estimates, so outside of the material that's included in the pre-feasibility study. And again, essentially all of these holes intersecting gold well above the average grades that are in the current study, and certainly economic at these levels. So, these are some of the deepest pits that we have on the project, because this is some of the best grade material. This is some of the material that's being mined in those early years currently, in those first 3 years. And this is where we believe we'll be able to find some additional material at, again, above average grades, and continue to both expand the pits to depth, and then ultimately, as Luke pointed out with our neighbor there at Chirano, these where you start to see the really high grades and longer life mines is following these, well-defined chutes. So we've got an advantage here in that the higher grades are defined right from surface, but then they continue on. Very consistent nature you can see here in this cross section. Again, this is what I would call the highlight hole, and the intercepts are below the level of the pit here. So this is the mineral resource pit, defines the material that's gone into the PFS, and you can see here in hole 102, 1.7 grams over 25.5 meters, and then a nearby intercept of 3.22 over 17. So a real good chance there to add additional material well above the average grades to be included in future studies. We had, again, I mentioned we've got some additional holes planned, both a little bit deeper down, but also laterally here along strike as well. So we've got one drill hole diamond rig specifically working at stepping out from some of these better holes we have released already this year. So yeah, zooming back at the project again. Just move on to the next slide here. Yeah, so again, we've talked about Boyne quite a bit. Sium, which again is the other one of the two relatively close-spaced deposits. This is actually our largest deposit. It's quite a bit different in its character than Boyne. You saw the Boyne structure was kind of one central structure that was quite steep in nature, whereas here at Sium, we've got a whole series of relatively flat-lying stacked structures, and this has allowed Sium to build into our largest resource area. What you're seeing here is basically the drilling on the right-hand side of these two cross sections, in particular the left one where you see the shallow holes on top of the ridge there. that was all of the previous drilling that was completed, and that went into the MRE. And these darker holes here with the intercepts, in particular hole 121 there with well above average grade intercept of 1.37 over 24 meters. That's outside of the MRE pit. This is some of the new drilling that we've just announced. So looking to, again, not only expand what is already our largest deposit, but again, the ability to focus on some areas where we've got some much better than average grade. So Sium's our largest deposit, but it's also our lowest grade because, again, most of it was within the oxide material there on top of the ridge. And having these sorts of intercepts that you see here, 1.37 over 24, 1.59 over 15 and a half, 0.8, 0.9 grams over multiple tens of meters. All of these occurring right at the base of the pit, just getting into the fresh material. This is going to give us the ability to again start to include in the updated MRE before the feasibility study material at Sium that in this case is probably looking at about 4 times the average grade of the material that we defined in the near surface oxide zone. So quite exciting to see these grades. These are the first deeper holes we've ever drilled at Sium. It's great to see that we're seeing the sort of grades that we expected, and we'll continue to. We've got another rig that's there working at Sium, and we'll continue to have the one rig working at Boyne and the other one at Sium. Again, here you can see the resource pits with the grade blocks for the MRE, and you can see the new holes that are highlighted here. These are the ones that we were just looking at in that cross section, and again, intercepts at anywhere, even the 0.48 grams is above average grade for Sium, and it's over a significant width of 41 meters there. So this is how you're able to build larger and higher grade resources, is having these nice wider zones at, again, either slightly above average grade or in some cases, again, 4 times the average grade of the current resource. So quite excited to see this very first deeper drilling at Sium giving us the sort of grades that we were targeting. It's just a quick image here of the geophysics in terms of the information that we use for looking at where these deposits step out. We've got a geophysics, and it highlights really well the structures. We've covered the whole project in soil geochemistry as well. Obviously, if you're looking for gold deposits, gold anomalies are the way to go. So yeah, outside of the deposits themselves, we've got a couple of dozen target areas, some of which we've advanced through trenching, some of which are, again, a combination of geochemistry and geophysics. And as we're continuing to build on the existing deposits, we'll also look to test some additional zones. So that's quite exciting to be actually doing some real greenfields exploration at the same time.
Yeah, thanks, Greg, for kind of running us through some of the exploration and the tremendous upside that we see from the drilling that we're doing at the moment. As we've highlighted multiple times, it's important to highlight that we've only included 28,000 of our current 80,000 meter drill program in this PFS, and the bulk of that really was focused on infill. So really, we took our PEA, MRE, and really infilled a lot of that to create the PFS. We're now obviously focused on expanding the resource, adding higher grade material, which we think will create a tremendous amount of value for future studies. And we're obviously very excited by the results that have been coming back thus far. So expect to continue to see lots of drill results coming from Newcore. As we mentioned, we do have 4 drill rigs turning at the moment. Management and board, we've touched on this before, but obviously, it's a team that does have a track record of creating a lot of value for shareholders. And we are, again, truly aligned through our 12% ownership in the business. Looking at the cap structure briefly, we currently sit at just over 310 million shares outstanding. The drilling that we're doing at the moment, we are fully funded for all of that drilling. And I think it's important to reiterate that today we're sitting at roughly a US $75 million market cap. So this sell-off that we've seen in the last couple of days, I think has created a real disconnect between the value of what we outlined within the PFS specifically, but then also the tremendous exploration upside that we've got across the project that we think will then feed into future studies and add even more value from a project perspective. We are well backed by deep-pocketed institutional investors, good volume in the stock so far this year, trading just under $1 million. As I mentioned, we do have 3 covering analysts, Canaccord, Haywood, and SCP. If you do have access to research from any of those groups, I would highly encourage you to go pull their PFS notes and you can see what their commentary is. And a lot of it, again, focuses in on this PFS today, creates a real fundamental, backable project. But ultimately, with additional ounces, will create a lot of value. It's important to highlight that we do have a tremendous amount of support from the government of Ghana. They see our project as one of 2 large-scale projects, greenfield projects in country that can be fast-tracked to production, and they're very supportive from a permitting perspective to see us drive this project forward. And ultimately, our view from a project perspective is all stakeholders ultimately need to benefit from a project. And probably one of the questions we get asked most from the local communities around our project is, when are we going into production? Because they see the tremendous opportunity that will create for the community from a job perspective, from a benefit perspective, and ultimately that's part of the reason why we've got such strong support to fast track this project towards production. With that, I think we can probably hand it over to Mal, who's going to bring up a number of the questions that we've got on this call.
Thanks, Luke and Greg. And I just want to thank everyone on the line for providing such great questions and for our shareholders for their continued support. So we'll kick things off with a question for Luke. When was the decision made to go from heap leach to CIL, and has this been communicated before?
So the decision ultimately evolved over the course of 2 years. Obviously, in 2024, we put out a study that outlined a heap leach project. On the back of that, we did, a huge amount of technical work over the course of a year and a half, additional met work, geotech, hydrological work, environmental work, all of those, all of that work, which then culminated in us conducting a trade-off study in the second half of 2025 and into early 2026. Through all of that technical work that was done on the project, we determined that going the CIL route was the best path forward. A few reasons for that. From a metallurgical perspective, we saw much higher recoveries using the CIL flow sheet. CIL projects are also the kind of bog standard or the standard way of processing gold around the world, but specifically in West Africa. So back to that slide that looks at all of those projects that Lycopodium has built across West Africa. Those are all CIL projects. So that's a real blueprint for us. So it was a process that kind of evolved over the course of a year and a half. And then when we announced the commissioning of our PFS, we announced that at the beginning of February this year, we outlined that that we were going the CIL route. So that's kind of how it evolved, and then culminated in us announcing that at the beginning of February.
Yeah, so just to be very clear, yes, this was communicated to the market earlier this year at the beginning of February when we commissioned the pre-feasibility study. Staying on the theme of more technical questions, and I think this plays nicely into the rationale for moving to CIL, but can you please dive into a little bit more detail on what metallurgy has been done on the deeper fresh mineralization in ore?
Do you want to take that, Greg, or do you want me to?
Sure. Yeah, I can jump in there. What we have completed is industry standard bottle rolls. So the big change going from heap leach to CIL, the heap leach tests were largely column tests, and that was reflective of the fact that you needed to be able to recover the material in these columns using the direct cyanidation, and then with the bottle rolls associated with the CIL, what we were looking at was both the oxidized free digging material and the non-free digging material that includes the fresh rock. And we did a series of bottle roll tests that, again, you're using cyanide, but are, in this case, looking at ground and milled material, because that's part of the flow sheet now is you're grinding and milling all of this material to various different grind sizes. So we looked at a whole series of bottle rolls at, again, the two different types of material, the free digging material and the material that's going to have to be drilled and blasted, that again is largely the fresh material. And then we looked at those at different grind sizes, and again came up with the optimal flow sheet, which was presented today.
Yeah, so I think really the key there is going into our study in 2024, a lot of the metallurgical test work had focused on the shallow free dig material that was amenable to heap leaching. And then over the course of the last 2 years, we've obviously done extensive metallurgical test work focusing more on the deeper material, including the fresh, that has led to the decision to move forward with the CIL, as we think that's the best value for the project long term. Staying on theme with technical, so we mentioned minimal pre-stripping, but the study mentions a 4.3 strip ratio. Can you please elaborate? Just want to highlight the difference. Pre-stripping is the waste rock you need to remove in the pre-production year prior to commencing operations. So that is minimal for this project. We have about 5 million tons at Boyne and Sium that need to be removed ahead of production. And then Luke, I'll pass it over to you to reiterate and comment about the 4.3 strip ratio that the project has.
Yeah, thanks, Mal. So looking at that strip ratio, and we've got, just let me find it here, strip ratio slide. So you can see here, depending on which deposit we're looking at, the strip ratio will fluctuate. At our Boyne deposit, we are seeing the highest strip ratio, but that also, is driven by the fact that we're seeing the higher grades there. At Sium, we're seeing the lowest strip ratio, which is also being driven, which drives that lower grade material at Boyne as well. So overall, 4.3 to 1 strip ratio. When you compare that, kind of to other projects across West Africa, it sits well from a strip ratio perspective. As we continue to ultimately drill out and look to expand and grow the overall size of the resource, then we'll continue to obviously update what that looks like from a strip perspective.
Yeah, and Sium benefits, as we saw in those cross sections, from the fact that it's a whole bunch of flatter lying stacked zones. So that basically just means that you've got a better ore to waste ratio closer to surface, and that again is very much reflective in the much lower stripping ratio. And even as we drive those pits deeper into this higher grade material that we've now tested with the recent drilling, we expect that Sium will continue to be our lowest stripping ratio. It also helps that the mineralized zones are daylighting, if you will, right at the top of that ridge. So again, that means you've got to move less waste rock to get to your ore. So Sium, again, is our largest deposit. We've had some good recent success drilling, and I suspect going forward it will continue to be our largest deposit and with our lowest stripping ratio.
Yeah, and it's important to highlight like the 5 million tons of pre-strip. The advantage of doing that pre-strip is it ultimately opens the ore body up and opens the pit up for mining. So you could incorporate that into your mine plan and start that on day one. But by doing a small amount, 5 million would be considered a small amount of pre-strip. It opens up all of those pits and allows us on day one to get immediately into the ore, which then allows us to drive that much higher production profile in year one of the mine. If we were to, kind of incorporate that into the regular mine plan, you would see a lower production profile in year one because part of that mining would ultimately be the opening up or the stripping of these areas. So that's the reason we kind of structured the mine plan the way we did, is get that done while construction's happening, and then we're straight into the ore and producing a nice high 134,000 ounces in year one.
Moving on to the processing circuit, can you provide the design grind size for the processing circuit and comment on the relationship between grind size, recovery, and power consumption? Luke, over to you on that.
Yeah, so this actually is one of the opportunities that we've got for the project. When we look at, and if you go into the study in detail, and we will have the full 43-101 tech report published in the next month or so, which will get into some detail on this. But what it assumes is 5.5 million ton per annum plant. What you'll see with a number of these plants in West Africa is that they're actually producing well above their main plate capacity, primarily when they're in the soft oxide material. So you're able to push a lot more material through the plant because of the nature of that oxide saprolite material. So what was assumed in our study was in year one, we're about 90% or not even a little more than 90% of the material that's going through the mill in year one is that really soft oxide saprolite material. So what's assumed is a grind size of 75 microns in that year one, because it's such soft material that's already basically been broken up naturally. After that, it's assumed that we move to 53 micron. One of the opportunities for us is, with additional test work, is to highlight that we can move additional harder transition material, and fresh material into a 75 micron milling situation. So that's one of the optimization opportunities for us. So in year one, it assumes 75 for the oxide saprolite material. Beyond that, it's 53. But one of the things, and that 53 is just driven by the lack of test work at a 75 micron level. So we are going to look at additional test work to prove out that, look, all of this material can be run at 75, which then helps from an OPEX perspective. It also helps from a CAPEX perspective, and then ultimately from a throughput perspective.
Great.
I don't know if that covered it, but if anything to add, feel free.
Perfect. So another question around all-in sustaining costs. Is there an opportunity to drop those all-in sustaining costs moving forward? One thing I will comment, and we've spent time on, is that years 1 to 3. That is what we're looking to build on. And what you will notice there is a lower all-in sustaining cost. Rationale for that is it is driven by your production, and your production is driven by your grade. So the opportunity here is to find that higher grade here, which will inherently drop the all-in sustaining cost. Luke, did you want to add anything to that?
No, I think it's a great point, Mal. Is the first 3 years of production that we're looking at here, driven by 0.8 grams per ton. With this additional exploration, we're looking to continue to add that type of material, more of it in year 3, 4, 5, 6. And the more, kind of 0.8 gram plus material that we can add, the more it's going to increase our production profile, which then helps our NPV. And when we look at the all-in sustaining cost in those first 3 years, which just trying to remember where it is in here, in those first 3 years, you'll see it is obviously lower than what we're looking at for the life of mine. And with that, ultimately that helps with the overall economics of the project. So again, you look here at the first 3 years, this higher production of, call it 130,000 ounces, is driven by that 10%, 20% higher grade that we're seeing. And then, that directly drives lower operating costs, cash costs, and ultimately all-in sustaining costs. So we're looking at about $300 lower from an AISC perspective with that higher grade material. So there's a direct correlation there, or inverse correlation. Higher grade, lower AISC.
And can you comment on what the assumed price per kilowatt hour was, as well as the diesel price?
Yeah, so it was 14 cents per kilowatt hour is where we landed. 12 or 14. 14, I think, was where we landed. And diesel ended up being 105 or 106, I believe.
103.
103. 103. Thanks, Mel.
Can you comment on the royalties in the all-in sustaining cost, and whether there's any expectation of those royalties to change moving forward?
Do you want me to take that, or do you want to take it, Mel?
Yep. Please go for it.
Yeah, so from a royalty perspective, you'll see earlier this year, Ghana came out and implemented a sliding scale royalty. That ranges from 5 to 12%. So at $4,500 or higher, we'll incur a 12% royalty, and then for every $500 below that, it goes down by 1%. So between 4,000 and 4,500, 11%. Between 3,500 and 4,000, you're looking at 10%, and then 3,000 to 3,500, 9%, and then it ultimately drops from there. So all of our sensitivity analysis that you'll see within our presentation, within our press release, incorporates that sliding scale royalty into it. When you look here again from a base case perspective, this includes the 10% royalty at 3,800. It also then includes Triple Flag's royalty. They've got a 2% royalty on the project as well. There has not been a lot of change to the mining code in Ghana over the last number of years. We were actually with the CEO of the Minerals Commission last week in Toronto, and we hosted him for a number of meetings with investment banks and investors in Toronto. And he kind of reiterated that, look, these changes happened with the parabolic move we saw in the gold price. Ghana's view was that, they should benefit alongside companies and investors with that move up. But, with the move up, if ultimately we see gold prices coming back down, then they should be readjusted accordingly. So that was what led to the sliding scale. They did not change the free carried interest, so that remains at 10%. Also, at the same time as the sliding scale royalty got implemented, it's important to highlight that they also removed a growth and sustainability levy, which was which was in place. That represented 2%. There was also a COVID levy, which they got rid of 1%. So yes, the sliding scale went in, which adjusted things to 5 to 12%, but 3%, so 2% growth and sustainability levy, 1% COVID, so 3% total got removed at the same time. I haven't come across anyone yet who kind of outright recognized that, who's not obviously watching Ghana very closely. So I think it's important that 3% was removed at the same time as this. The other thing for us specifically, given the aggressive drill program that we've got, is they also removed the VAT, the value added tax of 15% for drilling and exploration. So the way to look at that is we get an additional 15% meters as a result of being able to claim back that VAT. So that was another thing that was implemented at the same time as the sliding scale royalty. Hearing from the CEO last week, he was adamant that, look, these changes happened and they realigned the country, but there is no talk of further changes from a royalty and free carry interest perspective.
Yeah, I think that's very important to reiterate. At this stage, we don't expect any further changes, and the most recent shifts in royalty rates have been accounted for within the pre-feasibility study. For permitting and mining license, how will this project meet Ghana's increasing requirement for increased local participation? And was that factored into the pre-feasibility study? I will note this PFS does assume contract mining that would be with a local contractor group out of Ghana. But Luke, can you please add to that?
Yeah, so if you look at some of the changes from a implementation of a requirement to use contract mining in country, it's important to highlight that the bulk of companies in Ghana have used contract mining for a number of years. It is a very mature mining district, over 5 million ounces of gold produced every year. As a result, you've got a lot of competition in country from a contract mining perspective. So we always assumed contract mining for our project. So there's really no change from that perspective. We went out to multiple different contractors for the PFS. We got bids and quotes from those contractors. We then looked at those and incorporated that into the PFS. So from our perspective, it's what we've always assumed. And these kind of this implementation of contract mining in Ghana doesn't impact our study at all, because it's what we always assumed would happen. And if you look at most companies in country, that's the case. The 2 or 3 where there has been an impact is Newmont and Zijin, and that's where they've had owner-operated fleets, which they're now looking to move over to contract mining.
So staying on the theme of Ghana, what differentiates permitting discussions from those seen at Gold Fields recently and Bogoso Prestea?
Yeah, so we've got one of the 2 most advanced projects in Ghana. It's interesting when you look at Ghana as a whole. You've got 5 million ounces of production per year. Shandong built the Namdini project or brought it into production last year. They bought that asset in 2021. They re-optimized it, started construction in 2023, and we're in production by 2025. So I think that speaks to the ability to push projects forward in country, to go from buying a project to permitting to having it in production within a 3.5 year period is standout. For our project, it is one of the 2 most advanced projects in country from a development perspective. So we've got a tremendous amount of support from the government. They recognize that it will add a lot of value to the Enchi area. It'll obviously add value for a country as a whole, create jobs, create FDI, taxes, royalties, all of those things. So again, if you were with us last week in Toronto when we met with the CEO of the Minerals Commission, and last month we were in New York with the Minister for Lands and Natural Resources, Minister Bua. They have expressed their full support for this project. And on the back of this PFS, one of the key things for us to apply for a mining lease is to have reserves. So for the first time, we now have reserves that will then get incorporated into our mining lease. We're going to look to have that mining lease application submitted in Q3 of this year, so in the next 3 months, and we'll look to have that granted in 2027. So we've outlined that with the minister, with the CEO of the Minerals Commission, and they've committed their full support and said that that is a very realistic and achievable timeline. So we've got a tremendous amount of support, and it is one of the real differentiators, in Ghana and in a lot of West Africa, is the ability to fast track projects into production. With this PFS, we've outlined the economics that justify us aggressively moving it to a feasibility study, getting it permitted. While we're doing that, continue to aggressively explore, add ounces, which will, help improve the overall economics of the project, further justify putting it into production. And that's really the focus for us as a team at the moment.
So I think you've likely answered most of this, but how far along with the permitting timeline is the team? Is the team looking to fast track a feasibility study, mining license into operations on the back of the pre-feasibility study?
Yeah, so I think we covered the mine lease. So we now have reserves, which was the critical element to apply for a mining lease. We'll get that mining lease application submitted in Q3, so in the next 3 months. We'll then look to have that granted in 2027, and we've already spoke to the government, and they're very comfortable with that timeline and are going to work alongside us to get that done. From a feasibility study perspective, our view is the base case that we've outlined here more than justifies us aggressively taking this to a full feasibility. What we're going to want to do is incorporate a lot of this additional drilling that we're doing at the moment. So an additional 52,000 meters of drilling and maybe more could then go into an updated mineral resource estimate, which we would get done next year, which would then be the foundation for us to be able to go to a full feasibility. So that's our plan. And then obviously on the back of that, we would look to get the project funded and get it construction ready.
Maybe I'll just jump in there and say as well that, we won't be waiting for this updated mineral resource estimate. There's a lot of additional work that we can do. In particular, we talked about some additional metallurgy and looking to optimize the grind sizes and those sorts of things. We've got ongoing baseline work, hydrogeological work, geotechnical work. So we're not just waiting for that updated MRE before we even start a bunch of the work that we know will have to go into the feasibility study.
So if capital were made available, when would you foresee reaching production?
So our kind of timeline at the moment is apply for the mining lease alongside us doing the additional drilling that will feed a PFS, along with all that additional work that Greg highlighted: environmental work, geotech work, hydrological work, additional baseline work, and metallurgical work. We're doing all of that to a feasibility level at the moment, so filling in any gaps between PFS and FS to be able to then get a full feasibility study completed. So all of that's been happening over the last couple months and will continue right into 2027. So feasibility second half of 2027, at which point we would then look for project financing and ultimately look to get into construction in 2028.
And just to caveat all of that, obviously that timeline is as of today. As we get more information, we'll continue to have a better idea of those timelines as we advance the project and feed in the exploration success into the economics. Any options for running a small heap leach to get the project running? Over to you, Luke.
Yeah, so we, again, in 2025, spent a lot of time looking at different scenarios. And ultimately, we looked at the heap leach only scenario. We looked at heap leach plus a CIL scenario. We looked at a CIL scenario. And really, we landed on CIL was what made the most sense for the project. In terms of, size and scale, as well as, building a heap leach project. There's a lot of overlap in terms of infrastructure, roads, and building pads. And when you start to incorporate all of the capital required to do the heap leach, going directly to a CIL again is what made the most sense for the for the project based on all the technical work that went into those studies. So I don't anticipate starting with a small heap leach. One of the interesting things, if you want to look much bigger picture, and you look at our mine plan today, and that mine plan is obviously going to evolve with the exploration success that we continue to have. But you could see a scenario where we get into production with, the CIL and Boeing material, other material going through that CIL, and some of that lower grade material that we've got at Sium. You could potentially see at some point, bringing that into a small heap leach along the CIL to then ultimately increase the overall production profile. But short answer is no, I don't foresee us putting a small heap leach into production day one. But I could see once we're in production and using the cash flow from that to put in a small heap leach alongside it as something that could make some sense.
Yeah, I think that's optionality in the future. So with the 3 times higher upfront CapEx costs, how does this change your thinking around financing the mine build? Are we to expect large equity raises relative to your current market cap in order to get to first gold? How do asset sale, JV, or debt raise opportunities look at this point? One thing I'll just note before I pass it to Luke is obviously one of our key focuses is to bridge that gap. Our current market value, we believe, does not reflect the value of the project. And with the drilling that's underway, we hope that then has success in bridging that gap so that valuation gap isn't as large as it is today. But over to you, Luke.
Sure. So yeah, again, I think obviously putting a PFS out on a day like yesterday, and having parts of the market who didn't fully appreciate the additional costs involved of going directly to a CIL, led to a sell-off in the stock. But to Mal's point, I think we're, deeply undervalued at this stage relative to the NPV that we've outlined and the tremendous upside that there is from a pure project perspective, that's driven a lot by all of that exploration that we're doing at the moment that will go into future studies. So yes, getting us back to a point where we've got a more reflective market cap of, relative to the project and the exploration upside is something that, we've got to start from now, because obviously we got sold off yesterday. So we'll work on that and we'll get out there and highlight the tremendous value that there is. From a pure, financing perspective, project financing perspective, there's lots of different ways we can ultimately go with that. Debt financing would be a large component of any overall package that we would get in place. So if you look at 50% debt or 60% debt, then you've obviously got a leftover equity piece that needs to get filled. From a pure equity perspective, again, we've got tremendous support from our long-term institutional investors who want to see us fast track this into production as quickly as possible and start to reap the cash flow from that. But then beyond that, as we de-risk this project and move it forward, partners, outright takeouts of the company, all of that stuff will ultimately be on the table. If the market doesn't value us appropriately, and we often see this, market value for a project relative to what a corporate will pay for a project, there ends up being a complete disconnect. And that's where you ultimately start to see a lot of M&A and takeouts happen, is when you have that disconnect between what the value of a project is for the equity markets versus a corporate. So, as we move, and we've said this, countless times before, as you move a project from PEA to PFS to FS, you get permits in place, you de-risk it, all of that additional work that commands a higher valuation from a market perspective. That's where corporates also get very interested. So I would say, where we're trading today and that disconnect that there is from a project value perspective relative to, what the market is pricing the company at, is where there's also, the reality that corporates will get very interested because of that disconnect that there is. So that's the other kind of path. We continue to advance it. We fund it ourselves. We've got lots of debt providers who've expressed interest. They like Ghana. They want to be supportive. They like projects of our size, strong institutional support. But then beyond that, if there continues to be a disconnect in the market, then ultimately someone probably comes and puts a bid on the table that we would then need to take to our board and ultimately take to our shareholders.
So I think that's a great segue into a question about our board of directors and our team. Can you talk about the capabilities of the directors and officers with regard to construction and operations experience?
Do you want to take that, or do you want me to, or?
So we have a very, very strong leadership team, and one that has significant experience of creating not only shareholder value, but also operations experience. So with that, Luke, I'll pass it to you to dive into that detail.
Yeah. So when you look at our board and management team, it's a long track record of success in the mining sector. I mean, if you look at Doug Forrester, Blaine Johnson, they're co-founders of Newcore Gold. That was a brownfield project. Went in there, restarted it, brought it back into production. And ultimately sold that to Kirkland Lake Gold. Ryan King was involved in that all the way through. Then if you look at Calibre Mining, again, that was a $40 million market cap company, vended in the B2 Gold assets in Nicaragua to become a producing company, then bought the Marathon assets in Newfoundland, really ramped up and optimized the assets in Nicaragua. And then fast forward to today, they got merged and then got taken out by Equinox Gold. And if you look at the team that's running Equinox Gold today, they were primarily former Calibre management team. 4 of our current board members actually sit on the Equinox board today. From a technical perspective, Mike Vint, he's with Endeavor on the debt side of things and has a tremendous amount of operational experience. Alan Pangborn, he came in as a strategic advisor to us about 2 years ago. He's got a lot of experience in the mining sector. His last operational role was as COO of SSR. So he's been a very good technical advisor. And yeah, so we've got a strong team. But what we will also look to do is continue to add to the overall management team. As you go from PFS to FS to production, we'll look to bring in the individuals to help complement the existing team that's in place and really drive us along that path.
So just one question on exploration, and then we're going to pivot to a few last questions around valuation, cash position, trading to wrap things up. So over to you, Greg, on this one. How much lateral drilling are you planning roughly on Boyne and Sium to see if there's any material outside the higher grade shoots that can make the cutoff should the pit be expanded going forward?
Yeah, I think the answer to that is going to be very little, just because these chutes are so large. So when you look at that, what is essentially a longitudinal section, and you see those new recent drill results that we've announced below the level of the current MRE pits, each one of those chutes is half a kilometer to almost a kilometer in length along strike. So our goal will be to drill off some continuity for each one of those half kilometer to kilometer long chutes. In terms of this image that we see here, we see 3 of them. There's probably 3 more along strike at Boyne, and there's a similar number at Sium. So our drilling will concentrate, and again, by concentrate I mean zones that are half a kilometer or a kilometer long within these chutes. And again, that's the benefit that we have, is they're already now fairly well defined where we see the better grades and the better widths. We see that right from surface continuing to the bottom of the pit and now below the pit with these drill holes. So we will concentrate on these sort of sized chutes and look to, from the existing holes that we have that we've released this year, step out 25 to 50 meters. And again, the idea will be that we'll define this mineralization right to the indicated category, and this will be available for the future feasibility study.
And I'll just jump in that, yes, the focus right now is on defining these higher grades, but with the large scale drill program that we do have underway, there is an opportunity to find more near surface above resource grade across the district scale property. It is 248 square kilometer land package, 40 kilometers end to end. We have defined mineralization in 4 specific areas to date that exist in our resource. But above and beyond that, all of these deposits remain open along strike at depth, along with areas like Arati, Kogina Hill, Sium South, where we've had drill success, but we do not yet have a resource. And then in addition to that, a number of additional early stage exploration targets. So there is a lot more potential on the property, and we will allocate some of our drilling to continuing to define that earlier stage and advancing those earlier stage targets. Luke, do you want to add any last comments on exploration before we wrap things up with a few questions on the company?
No, you guys have highlighted it. Obviously it's a district scale exploration program. The average vertical depth of the pits that constrains our resource today is only down to 85 meters. And this is something we've consistently talked about. And, now we've got 4 drill rigs turning. This is the first time we've had 4 drill rigs turning in the last number of years. So we're aggressively drilling on the project. We think that can create a huge amount of additional value that'll then go into feasibility studies, into the overall project economics, and think that that's a really good place to be at the moment. So expect lots of drill results from us, and we're excited to continue to see the positive impact that will have on the project.
So a few last questions before we wrap things up, likely in the next 5 minutes. Luke, what is the balance sheet, cash, any warrants left? What's the 12-month budget?
Yeah, so if you look at our cash as of the end of May, we were sitting at 18.8 million. So everything that we've talked about in terms of the 80,000 meter drill program, bunch of that additional work from a feasibility perspective that we're doing in the background, that's all funded with the cash on the balance sheet today. So we're funded right through the end of 2026 and into 2027. And then, we're 55% institutionally owned today and continue to have a lot of support from those investors to keep driving this project forward. mean, as I mentioned, I was blown away that we've traded down to a US $75 million market cap on the back of outlining a project that's got an NPV of $500 million at a $3,800 gold price. We went through the tremendous leverage to the gold price that our project has. When you look at it, average gold price of 4,800 in 2026. So, that is a resetting of the company. And obviously, we needed to do a better job of communicating the additional costs that are associated with a CIL project. But from here, I see huge upside for investors, and us as 12% owners of the business are obviously steadfast on communicating that and creating that ultimate value for shareholders.
So we are funded going forward for this year for the 80,000 meter drill program, of which we have this year released 12,500 meters, and of which 28,000 went into the mineral resource and pre-feasibility study. So a lot more drilling to come. And just to be clear, there are no more warrants within our capital structure. So with the strong volumes that we saw, obviously the last 2 days, or yesterday and going into today, Luke, did you have any significant shareholders or institutions sell yesterday?
We didn't have anyone that we know of. Obviously, the market's a bit of a black box in terms of knowing who's selling or buying. That being said, did have a couple of individuals get in touch who kind of see, similar to us, a real disconnect in terms of where we're trading today and yesterday, and stepped in and bought a bunch of stock. Some of their rationale was, you look at our resource, 1.5 million of indicated, another 600,000 ounces of inferred, 2.1 million ounces trading at a $75 million US valuation with a PFS that outlines a $500 million project at $3,800 gold. It just doesn't make sense to be trading where we are. But listen, I take, responsibility that we didn't probably communicate properly, some of those additional costs, and there was a definite knee-jerk reaction by the market. So, that's on me for being at the helm and not making sure that was ultimately communicated. But from here, again, we see a huge amount of upside.
So one last question from a shareholder. Thank you for your work today. Given the market's reaction to the pre-feasibility study, what milestones do you think are required to close the valuation gap? And how many meters of drilling are not in the pre-feasibility study that you have done so far? I think this is a great question to wrap things up. Again, we have a lot more drill results to come. So from the 80,000 meters, 12,500 meters were reported this year that have not been included. And then we have almost another 40,000 meters to go. So lots of drilling, lots of news flow to come. And I'll pass it to Luke for the closing remarks on what he thinks the milestones are that we need to achieve to close this valuation gap going forward.
Yeah, so drilling, as Mal highlighted, as Greg went through in some detail, the PFS today is obviously a snapshot in time. It creates a lot of fundamental value for the project. It's a much more defendable, credible study than what we saw with the PEA. A lot of technical work went into producing this PFS, as well as all of the studies in the background. What was encouraging is, yes, it's painful as major shareholders to see the reaction that we saw yesterday in the market, but we also got a lot of very positive feedback from a lot of very technically focused investors, from a number of our covering analysts, as well as a number of our peers in West Africa. So again, that disconnect between, the market and industry is something that, for me was very encouraging to hear that feedback yesterday. We will have a lot of drill results to come. We've got 4 drill rigs turning, so that will obviously produce drill results. On any given day, we could wake up and find out we've got another big, wide, high-grade intercept that will point to additional ounces and upside for the company. We will apply for our mining lease. That is a critical element for any project and a major de-risking event. So we'll apply for that in Q3. We'll look to have that in place in 2027. So that'll be another major milestone. And then in the background, all the additional de-risking work. So additional metallurgical work, hydrological work, geotech work, environmental work, baseline work. We've been doing that continuously for the last 1.5 to 2 years to get us in a position to be able to produce the PFS. And we've already started on the path of getting the full feasibility level work done to be able to produce that feasibility study. So that's additional work that'll be happening in the background. Obviously, it's less news flow worthy, but from a project perspective and from a value creation perspective, often more with the industry than anything else, that's also happening in the background. So drill results, mine lease, and then all of that leads to a full feasibility study is where we think we'll create a lot of value from here.
Thanks, Luke. I want to thank everyone for joining today for the webinar and for the great questions. Really appreciate that engagement level. So we're going to wrap things here, but please do reach out to us directly if you do have any further questions or want to have an update with our team. I also encourage everyone to follow us on social media. We post a lot of great content on there, on X, on LinkedIn, on Facebook, on YouTube. And with that, I just want to thank everyone again and hope that everyone has a great rest of their week.